hitting that key level that Ira Jersey yesterday was talking to us at Bloomberg Intelligence, that is a key technical level. So let's check back in with Will Hoffman this time, Bloomberg Intelligence Senior Rates Strategy Associate. Okay, so if we get to like a 4.7, how do you guys see the 10-year evolving?
So 4.7 is about where we're hanging out right now. We think 4.74 is the close from early April. That's really going to be the big number, and particularly if Bloomberg Economics' NFP call for this upcoming Friday at 268,000 payroll ads is realized, we may see that 5% number here in a hurry. But the question is how long it sticks and what that does to the underlying economy. Rates up that high, particularly out the curve, are going to slow economic activity. It's just a matter of how long they stay there and how deep it goes. But for right now, growth is solid and yields are reflecting that. Prior conditions and embedded expectations were really weak coming into September. I mean, feels like forever ago now, but Powell saying, hey, we do not seek or welcome additional cooling in the labor market was a pretty striking quote. And now it seems like those labor market downside surprises have pretty much stopped. And the question is, do we see upside surprises from here, which BE has been flagging?
Will, how do you think the Fed is kind of digesting some of this, I guess, better than expected economic data?
Absolutely. So Powell, I believe in December, had a comment specifically to the rise in yields post, I think the low was September 16th, just prior to the September meeting. And he attributed it to growth. And frankly, a lot of that is absolutely the case. The question of how much of this move has been tariff rhetoric or policy uncertainty is absolutely a great question. But the vast majority of this move, as Ira and I have highlighted in pieces out late last week as well as early this week, it's been the economy. The economy was expected to slump, and it's been upside surprises, or I should say fewer downside surprises, and now some upside surprises in hard economic data, and that's been spurring yields higher.
Just some breaking news for you. Canada's Finance Minister Dominic LeBlanc won't be running for Liberal leader. He just took the helm of Finance Minister since December of 2024 when Chrysler Freeman stepped down during much turmoil. So he will not be running for the head of the Liberal Party. Of course, if he did, he would then be elected Prime Minister. If he won, he will not be in the running for that. What's interesting, though, is how much I've read, Will, about why long ends are moving higher. You can make an argument, you look at forward inflation expectations, they haven't really moved that much. So is it really about inflation? Is it really more about the budget deficit? Is it about growth concerns? Where do you guys sit on that?
So, if you look at the local lows in about mid-September, since then, 10-year, and we'll just speak in 10-year yield space for simplicity, but 10-year break-evens have risen, but they were from an incredibly low point, and I'd call that more normalization. I believe it's mid-30 basis point move, but all the real move has been in real yields. No pun intended, but and those tend to reflect volatility, budget deficit, as well as growth expectations. But given the move in SOFR future space of the terminal rate pricing, it appears its majority of the move is economic strength, and maybe a little bit less some of the uncertainty that we're seeing in forward policy guidance from the fiscal side of things. But until there's concrete news or plans, the market may continue to react.
Hey,
go ahead.
So, Will, just real quickly, the real yield, Tom Keene likes to look at the real yield, 2.29%, the highest since November of 23. What does that tell us?
Yep. It tells us growth expectations, realized volatility, and deficit expectations are not falling. In fact, they've normalized pretty substantially. The question, I think, from here is, does growth continue to stabilize, or does it reaccelerate? In the latter case, I think we see a pretty material bear steepening. It's not our base case for the economy or yields, but if the Fed holds off with maybe one more cut next year and growth continues to move upwards, we will see the curve steepen from here. It's just a matter of when and how much.
All right. Well, thanks a lot. Really appreciate it. Will Hoffman, Bloomberg Intelligence Senior Rates Strategy Associate.